Good afternoon and a very warm welcome to all the registered valuers and the members of ICI who have joined us today to this very important session on the valuation of ESOPs, a topic which never dies down. And for this, we have with us Mr. T.V. Balasubramaniam, who is a member of the Institute. He is also a registered valuer and associated with the Valuation Standard Board and the ICI RVO for a long time and helping us in all the technical and professional development activities. Now, as the topic for today stands, we are talking about a rather non-conventional method of increased capitalism amongst the employees. And what has driven this innovation is globally, if we see the 1950 onwards, we saw the conception of ESOPs coming into place. And while the technology companies or the startup companies, they have been the harbinger for being the driving force in having the ESOP getting as a permanent method of a compensation package. If we look at the Indian scenario, in last decade or so, we had about 70,000 startup coming up and nearly 100 of them achieving the status of unicorns. Now, what drives innovation? Because these are the companies, whether these are the companies in the startup era or the technology companies, possibly they are driven by an idea that is conceptualized and given a commercial shape. So possibly the kind of threshold which is required for hiring in terms of the manpower, in terms of their skill set or the compensation packages, possibly that is a bit different from the conventional method of hiring. So what the enterprises have started doing is that they have been providing stocks or shares to their employees, and these are mainly that reason is that they are able to thwart the attrition and increased engagement, and in a way it is working as an employee benefit plan. Now, if ESOPs are existing as part of the compensation structure, now ESOP would technically employee stock option plans. So there is a equity stake, either direct equity stake or a cash payout in the equity stake. Now, how this shared capitalism has come into play is because the driving force is the entrepreneurialization of the entire activity and a democratization process that the not only the star employees but many of the employees, they own the business setup. And while this has proved to be an effective driver in promoting employee engagement, uh, what has happened is over a period of time, they are being seen as financial instruments, allowing for better financial management because startups or technology companies, when you start a business, possibly you are collaborating with your partners in a way that the journey is unknown, but we sell a dream and try to conceptualize and effectuate that dream. And on fruition or in the process of fruition, there is a willingness on the part of the company or the enterprise to duly compensate by way of ESOPs. Now, it is not only the ESOPs, the another innovation which has come up is the stock appreciation rights, which is again the right to receive the benefit of increased appreciation in the value of company stock. And it could be either stock or cash or a combination of the cash and stock. Now, traditionally, when we see how the ESOPs are happening, either by way of fair market value of the stocks or by of a concession or a cashless transaction. In fact, the institute has brought out its standards, the Ind AS 102, and there are other guidance notes as well. There are many concepts like the grant date, vesting period, vesting date, exercise period, lock-in period. So all these are very relevant for the purposes of valuation. Now, the entire thing, which from the accountant perspective or the valuation perspective, from the perspective of a valuation professional, is the valuation of these ESOPs and how this is to be done. Because when you are recognizing the repurchase obligation, how it is going to affect the valuation, and if you take into account the lock-in provisions for the sweat equity. Now, session today, Mr. TV Bala Subramaniam, he will be addressing the meaning of ESOPs and SARs, and how they have come into play, and what are the accounting treatment, what are the regulatory treatments to be given in terms of their valuation for accounting purposes, taxation purposes, how they are to be valued, and what are the preferred methods of valuation. And more importantly, because in a way it is a something which is going to accrue over a period of time, the volatility or the what do you call the change in the business scenario, how it affects the balance sheet. And in terms of various business scenarios, supposedly the company plans for a M&A or a takeover or fundraise, then how these SOPs, the treatment changes. So I think with these small background, I would request Mr. TV Bala Subramaniam to address the audience and share his perspective. The session has been kept in a very simple manner. He will be making his presentation, and after the presentation or during the course of the presentation, if there are any questions, possibly they could be sent to us over email. So in the last 15-20 minutes, we would try to address your understanding of the topic, or if there are any gray areas which further require any elaboration. So with these words, thank you so much, Mr. Balasubram, for joining us, and over to you now. Thank you.
Thank you, Udar. Without much time being spent, let me take on to the session. And as Shegalji mentioned, we look forward to your questions, so we could take it up at the end. We'll set aside some time where we could go through that specifically, so it is more useful for everyone. I have tried to take this topic of ESOP with some practical case studies so that it becomes easier for us to understand, and there is a point of focus for us to also learn from looking at those. So what I'm trying to cover today is when all ESOP valuations get triggered, and then at the time of grant, what kind of valuations are required. Valuation of the share itself will be required if it is an unlisted company. In the case of listed companies, obviously share value prices are available. Whereas in the case of unlisted companies, there is a need to first of all value the share as of the date at the time of grant. Then there is also a need for valuing the stock options, which will apply to both listed and unlisted companies. We'll also touch upon the accounting requirements, whether annual recomputations are required, where it is required, and what kind of annual recomputations come into play. And then how do we account for lapse grants, pre-vesting and post-vesting. Then what are the intricacies of accounting for valuation of SARs or phantom shares. Then I'm also touching upon how do we treat the ESOP whenever we are doing a valuation for, say, other purposes like fundraise, etc. So I will also give some practical sides to it. Of course, these are indicative, and there could be circumstances and situations which may require specific different treatment. We will look at these straight. So first, looking at when and what triggers valuation of ESOPs. So as Shegalji was mentioning, there is the grant date, which is the date on which the options are being made available to the employees. And there is the exercise date, which is when the employee actually exercises his grants or the options given to him, and he is obtaining the shares or the cash, as the case may be, depending on how it is to be settled. So there are two times at which it could get activated, the trigger. The first is at the time of grant, and the second is at the time of exercise. This is a general. We will also see the exceptions. At the time of grant, the purpose of valuation is primarily only for accounting of the ESOP cost by the company. So it's primarily only for the purpose of accounting that this valuation needs to be done as at the date of grant. Valuation has to be done under the Companies Act, more importantly, the accounting standards. India is 1 or 2 in the case of India's companies. And in the case of AS companies, there is a guidance note which is applicable. So based on that, the valuation needs to be carried out. Valuation has to be carried out in this case by a registered valuer, because under the Companies Act, all valuations under the Companies Act are expected to be done by a registered valuer. The item to be valued at this point of time, there are two things which may have to be valued. As he was mentioning, if the share is unlisted, the equity share itself needs to be valued, and then the fair value of options also needs to be computed. The other thing which needs to be considered is you need to take care if there are other valuations being undertaken by the company around the same time. For instance, there is a grant happening. At the same time, there is also a specific placement happening. Let's say an IPO is happening, or a private placement is happening, etc. Then you should have a reconcilable reasoning and rationale for the price at which the issue is being made for other purposes and the cost which is being considered as the share price for the grant. So that is why it is very important to see what are the valuations which are being undertaken by the company around that time. It need not be exactly on that date. It could be before, after, in that region. If there are any transactions happening, we need to keep that in mind. The second time when valuation is required is at the time of exercise. At the time of exercise, it's primarily the purpose of valuation is for determining the perquisite value in the hands of the employee. So this is for income tax. So at the time of exercise, there is no need for an accounting valuation generally. It is primarily for the purpose of determining the perquisite value in the hands of the employee. And it has to be done under the Income Tax Act. And because it is under the Income Tax Act for the purpose of determining the perquisite value, the valuation generally needs to be carried out by a merchant banker. And at this point of time, the option is getting exercised and there is a share coming into being. So what really requires to be valued is only the equity share. If it is unlisted, of course, if it is listed, the share price is already available. This is the broad triggers for ESOP in the normal course. However, we need to be careful to understand that in the case of SAR alone, there could be a need for valuation at each year end also, each reporting period. So that is something we need to keep in mind. So first, let's start with the first part of valuation of shares at the time of grant. Now, here, the key thing which I would like to bring about is we all know about valuation of shares, etc. But the key thing which I wanted to bring to light is there is a key difference which we need to bring between a valuation for ESOP and, say, for example, valuation for an issue to share a strategic investor or an IPO. The standards very, very clearly bring out that purpose of the valuation is one of the things which needs to be specifically considered in the approach to valuation. And purpose of valuation do have an implication on the pricing which you end up with. So in an ESOPs, so let's look at the difference between the ESOP valuation and valuation for strategic investor or IPO. What drives these? ESOP valuation is generally based on fundamentals, whereas strategic investor discount for risks related to unlisted shares will have to be considered in the case of ESOP, because it would be mostly unlisted and there could be no immediate roadmap for IPO. That is also to be factored. And most important is ESOPs are being made to either make it attractive for enhancing productivity or for retention, etc. While this is so, in the case of issue to strategic investor or in the IPO, there are strategic intents, global possibilities. There is a much more aggressive outlook in the whole approach to issuing capital. There is also control premium which is involved when the issue is made to a strategic investor, maybe not in the case of an IPO, but in the case of strategic investor, there is a control premium which is involved. In the case of IPO, we need to also consider that it will become listed. So the liquidity is going to be far better. And the whole approach to valuation here is to maximize value for the company. So the rationale is already there for valuing for ESOPs on a conservative basis. Now, this is the theoretical part of it. However, let's also look at an example of what had happened in the past to see that this is actually the case, how the market or the industry perceives. Of course, I have taken a little dated data primarily to not get into any controversies in using the data relating to any company. So this is the case of MT Educare in the year 2011-12. So in the year 2012, MT Educare went for a public issue at the price of 80 rupees per share. Whereas in 2011, the company had issued 2 ESOP schemes. And these were issued under certain factors. And the data here is presented based on what has been reported in their annual reports. Now, using this data, if we compute backwards in the Black-Scholes model and try to arrive at what has been the share valuation they have considered to arrive at this kind of a ESOP cost, the share valuation translates to 36 to 38 rupees at the time of issue of ESOP. So in 2011, the company's shares were being valued at 36 and 38 for the purpose of ESOP. And in early 2012, the company's shares were issued on IPO at 80 rupees. So within a year, there is a huge difference between the prices which are being considered as a fair value of the share for different purposes. Now, this is the computation which we have done to arrive backwards to the price of what is the price of share which they have considered. Now, from the data which is presented in the annual report, we know that the ESOP costs are about 36.56 lakhs and the ESOP 1 costs were 78.3 lakhs. And we also know the number of options which were issued. And making some assumptions about the various parameters which they have considered as per the data presented again in the annual report. We work backwards, the share price comes to something like 36 to 37 rupees, which is what they seem to have considered in doing this valuation of ESOP. So this, when we compare it with the 80 rupees, what seems to be the logic or rationale behind it? Let's also look at that. These are, of course, in hindsight working. Obviously, after 10 years, we have so much of data to look at and in hindsight come up with answers. But that exactly is what I'm trying to do. I'm trying to present how probably the industry and the market seems to have looked at these at that time. So March 2011, if you look at the net worth, as against that, the September 2011 net worth, there is an increase which has happened, and book value per share has gone up from 14 to 16 rupees. Now, if you look at the market value which has been considered, it was 36.75 based on the ESOP price valuations and 80 rupees based on the IPO price valuations. So if you take the number of shares based on that, the market value has been considered at some 12,000 lakhs and 28,000 lakhs. So this is the kind of numbers which they seem to have arrived at. And if you look at that and compare it with the average PAT for 3-year trailing, I'm just taking a simplistic approach to it. The PE ratio based on 3-year average comes to around 23 in the earlier case and 34 in the later case. PU ratio based on just last 1 year comes to 15 and 20. And book value multiple comes to 2.64 and 4.94. You can see the aggressive kind of valuations which are happening between the two periods for different purposes. The first one was primarily a valuation done for ESOP. The second one was primarily a valuation done for IPO, or the pricing arrived at for IPO. So you can look at and you can understand that the industry, the market, everything is looking at a more aggressive outlook when it comes to IPO or strategic issue, etc. vis-a-vis valuation for the purpose of ESOP. Now, just taking this same numbers into consideration, if I take the PAT for March 2011, which was just before the ESOP, 824, and number of shares, the EPS comes to 2.4. Now, if I look at the April 2011 CNX average PE, that is the index PE, it was 20.43. And to that, if I give a discount of illiquidity 25%, these are some assumed numbers. Say 15 is the adjusted PE ratio, which is coming to. And 2.4 EPS and 15 PE gives a value at fair value on a simplistic model to 3680, which is close to the kind of ESOP pricing they had adopted. Now, this is at the time of April 2011 when the ESOP pricing was being done. Let's look at the IPO time, how it changes. Now, first and foremost, PAT for half year for 2012 was 975. On an EPS annualized basis, it is 5.55. Here you can look at this thing that probably they have taken a more aggressive approach, not using TTM, but instead using half year into 2. So 5.55 is the EPS on an annualized basis if we take the latest half year performance. And the CNX average is also slightly gone up. However, if you apply a discount for only 15% to it, because it's close to IPO, it is not yet gone for IPO. So obviously there is some illiquidity impact, but it's not that there is no roadmap to it. There is clearly a roadmap. So you're taking a lower liquidity discount. You arrive at adjusted PE of say around 15. At that 5 into 15, you are getting 80, which is a more aggressive approach because it is close to an IPO round or it is being done for an IPO. So these may be the ways they have looked at the valuations at different points of time. And this also reflects clearly that there could be a significant outlook difference in the way they do valuation for ESOP and for other purposes. So one of the key things which I would like to highlight coming from this is that we need to take a more intrinsic and more conservative approach in valuation of the shares at the time of valuing for ESOP. However, very clearly, as I mentioned earlier, we need to be cognizant of the valuations which have happened in the company for any other purposes near around the same time. And we should be able to justify or give a rationale for any differences in these values. For instance, in one company, there was a preferential issue at a certain price. And around the same time, ESOPs were given at a lower price. Now, the justification given there was based on the this thing of one was the control premium or the block premium, which will be there because the strategic sales or the preferential issue was for a strategic block, whereas ESOPs are small quantums. So these are the things which needs to be specifically considered, and you have to be clear that if there are other valuations around that time, that you are able to rationally justify the pricing differences between these. Now, this is not the only example. I want to give more examples. And in fact, I have done it 2-3 times across different decades. And I have broadly come to the same kind of thing. Of course, companies which went for IPO and 6 months before, if they had given 6 months or a year before, within a year, if they had given ESOPs, I found time and again that there is a broad 50% difference between the valuation for ESOP and the IPO. This is one example of what I had done quite some time back. Of course, Tata Consultancy was an exception where they consciously gave it at 1 rupee. So it has no relevance there. But by and large, you can see from the other companies which went in, of course, many of them do not even exist today. That's a different issue altogether. But it can give you a difference in terms of the share pricing, how they approach during ESOP and the IPO time. And that there is, in fact, a discount to the IPO price when ESOPs are done, say 6 months or a year before that. So we already know about valuing shares. The key point which I wanted to highlight was how do we differentiate valuing shares for the purpose of ESOP in case we need to value the shares at the time of grant for the purpose of ESOP in unlisted companies. So that's why I wanted to take an example like this and also give you comparison as to what's happening in the industry, that it is more appropriate to be a little more conservative in the overall valuation of the shares at the time. Now let's look at the options valuation. Now we have valued the share, but we need to also value the options, which is what will be used for accounting. And the first one we are going to see is exactly for the purpose of accounting. What is the value of options and how do we go about accounting for it? The most used method is the broadly what is known as the Black-Scholes option pricing method, which essentially is actually the Black-Scholes-Merton option pricing method, which is used where we also build in the dividend component into it. The mathematics underlying these Black-Scholes model and all is complex, but as valuers, we need to understand tools are readily available to do the computation. Where we need to bring in our input is more in terms of the judgments which we need to place and the choice and selection of the variables and the judgment again relating to those variables. This is where the key difference comes in. So basically, let's look at Black-Scholes model and what does it actually entail. There are some underlying basic assumptions in using a Black-Scholes option pricing model. The first one is it presumes that there are no dividends. However, like I said, though we call it the Black-Scholes model we generally use what is known as the Black-Scholes-Merton option pricing model, where dividend is also built into the model itself. That's what mostly is used very widely in option calculations. Then the second assumption is that there are no transaction costs for sale, purchase of the stocks. So essentially, the computation is based on no other costs or efforts being valued involved in that. Then the third is risk-free rate of return is known and is constant during the option's life. So we are assuming that the risk-free rate is going to remain constant. Like let's assume the exercise period is 10 years. We are assuming today that for the 10 years, we know what is going to be the risk-free rate and it's going to be constant. Now, this is one big assumption which is going in, so which we need to also be aware of. Then buyers can also borrow any fraction of the purchase price at the short-term risk-free rate. So there is flexibility and there are no lots, there are no volumes, there are no this thing, everything can work at fractions. There are no penalties for short selling. That is the other assumption which is going into it. Then call option can be exercised only on the expiration. So which means if I make a grant, there is a clear exercise date on which date only the exercise can be done. That is either the shares can be taken or it can be given up. There is no option in this Black-Scholes model for the exercise to happen anytime during the exercise period. So this is something which is critical. We need to understand. The next assumption is that the security trading takes place in a continuous time and stock prices move randomly in continuous time. This is an assumption which underlies many of the things connected with stock valuations. So we have to take that also as part of the key thing. The assumptions which we take. So finally, if you crystallize this, what are the key assumptions which we put into the Black-Scholes Merton option pricing model? So as I was saying, we prefer to use the Merton option pricing model primarily because it considers dividend. So let's look at the key 6 assumptions which are going in. Yes, is the current price of the underlying stock. Now, the current price of underlying stock is the first factor which we are going to be taking, one of the assumptions which goes into the option pricing valuation. The second is the dividend yield of the underlying stock. The third is the strike price specified in the option contract. So, for example, what does it mean? It means the price at which the options can be exercised. For instance, when the ESOP is given to an employee, let's say 100 options are given, each option can be converted into one equity share. And let's suppose today's market value of the equity share is 40 rupees, and the option can be exercised at, say, 20 rupees. Then, yes, the current price is 40. K, the strike price is 20 because I can exercise it at 20 rupees. R is the risk-free interest rate over the life of the option contract. And as we discussed earlier, the rate is assumed to be constant over the life of the option contract. T is the time remaining until the option contract expires. So this is basically the period from the grant date to the vesting and to the exercise. Now, these 3 dates I should again explain for those who would like to have a relook at these terms. Grant date is the date on which the options are given to the employee. Vesting date is when the employee becomes eligible to exercise the shares. So this could be by just a lapse of time and he continuing to be in employment, or it could be by basically certain parameters which are achieved. Like, for example, if the company's turnover crosses crores, if the profitability of the company exceeds so much. So there could be criteria like that, which becomes the basis for determining the vesting date. So vesting date is when the options which were granted on the grant date becomes available for the employee to exercise. Now, exercise date is the date by which the employee has to decide whether he is going to convert the options into equity or he is going to let them lapse. So the time remaining in the option contract is from the period of grant up to the date of exercise. So that is the time which is to be considered. Sigma, which is the price volatility of the underlying stock. So the stock price, current stock price, we know. We need to also know its volatility to determine how it is likely to move in future. So that is determined by the volatility, which is represented by sigma. So these are the 6 factors which are considered in the Black-Scholes model in computation. So let's go into the individual item. So first one, let's say you look at strike price. The lower the strike price, that is the lower the price at which I can exercise as an employee, I am given option to exercise it at a lower price for the given stock. The option is worth more. For instance, today the market value is 40. If I am allowed to exercise at 40, if the option price is X, if I am allowed to exercise it at 30, then obviously my option price should be more. That is, the option should be worth more than in the earlier case. So this is what it means. Because a call option lets you buy at a predetermined strike price. That is the key thing here. We get to buy at a predetermined strike price. The second important issue which we need to note is the time until expiration. The longer the time, the more the option is worth. Now, for example, today Hindustan Lever is trading at 1,000 rupees, and you have an option to buy Hindustan Lever at, say, 1,000 rupees itself today. Now, it doesn't have much value to you because everybody can buy at 1,000. Now, if you are given an option to buy at 1,000 for the next 1 month, well, you have a great opportunity. Now, let's suppose you are allowed to buy it at 1,500 rupees anytime within the next 1 month. You don't know whether 1,000 is going to become 1,500. The possibility of that happening within 1 month is very small. But let's assume you are given 1 year, 2 years, 3 years. The more the time to buy at, say, at 1,500, a share which is currently trading at 1,000, then the possibility for it to be above 1,500 is significantly higher as the time increases. So the option is worth more as the time to expiration increases. So this is something which we need to keep in mind in the valuation judgments which we make. Stock price, which is the underlying stocks price. In the case of listed company, it could be the market price. In the case, the higher the stock price, the more a given call option is worth. The more the stock is worth today, I'd say the given same, let's suppose the exercise is permitted at par value. If the stock price is 40, as it increases, the option worth increases accordingly. Volatility is the measure of change in the price which is expected to happen in the future based on what's happening with the stock. Now, if the volatility is higher, the option always gets to be more in value, primarily because you have a higher potential of having an increased value in time to come. Dividends. A company that pays a large dividend will have a smaller option premium than a company with lower dividend or nil dividend, everything else being equal. So dividend, what happens? During the period you are holding the option, there is some value decretion happening by dividend payouts. So the more dividends are paid out when you are not a shareholder, but before you become a shareholder, you're only an option holder, the lesser value will come to you. So obviously it will have an impact on the option premium. That's why dividends are also factored into the valuation in the Black-Scholes-Merton option valuation, which is a variation of Black-Scholes model. Risk-free interest rate. The higher the risk-free interest rate, the higher the option premium. So the more the risk-free rate, the more the option premium can be, because the means that the call premium might rise for the put call parity equation to hold. So every time the put call equation has to hold, with higher discount rate, the premium must also rise. Now, I have presented here the complete formula and how you can build your own Excel model for option valuation using Black-Scholes-Merton option pricing model. Why I prefer this to the tools which are available in the internet is this tells you how it exactly maps with the formula which you read in books, etc. The formula is also given here. Everything is given here. So you could change the numbers yourself and rework or work your own ESOP calculations using this model. So this is something which you can put to use practically and pragmatically in your computations. Just to recap on the option price valuation, coming back to the specifics. So underlying stock price, any increase it has an impact on call by an increase. On put, it has a decrease in impact. Strike price has exactly the opposite effect. Time to expiry, very interestingly, both on call and put, it has an increasing impact. Similarly, on both call and put has an increasing impact. That is, with more time to expiry and more volatility, both call and put option prices go up. Then risk-free rate in the case of call options goes up. In the case of put options, it reduces. Dividend yield, the more the dividend yield, it reduces the effect on call option, whereas it increases the effect on put option. So these are something which we need to consider. Generally, when we are doing an ESOP valuation, we are talking about a call option valuation. So we won't look at the put, but just to understand the interlinkages and important to note. So let's also now look at an example of a multi-stage grant. And let's take an example of a case where the stock price on the date of grant was 93.3, right? So it is already trading at 93 rupees. The grant is being made. At the time when the share price was 93.30, the grant is being made for the options at an exercise price of 35. So literally 1/3 or close to 1/3. And the date of grant was, let's say, 31/10/2005 or 25, whatever you look at. Number of options given is about 1 million options, which is being given. Method of settlement will be by way of cash. Vesting period, which we were talking about, is the period in which the right accrues. The options get crystallized for the employees to exercise over the vesting period. Here, it is a 4-year vesting period from the grant date. And the exercise period is 10 years from the vesting date. So it is overall 4 plus 10, 14 years time duration for the whole option, right? 14 years is the time period. Now, what are the vesting conditions? This is a graded vesting. So all shares do not vest at the end, but it is graded vesting. So 10% of the options vest at the year of 1 year end itself. So after 1 year from 31/10/2005, 10% of the grants will get vested. 20% of the grant will get vested 2 years from the date of grant. 30% will get vested 3 years from the date of grant. And the balance 40% will get vested at the 4th year end. So this is called as a graded vesting. Now, when there is a graded vesting involved, these 4 will have to be treated as 4 different ESOP tranches, and valuation will have to be done for all the 4 separately. And they have to be accounted over the vesting period applicable for each tranche. For instance, the whole cost for the first 10% will have to be written off over 1 year. The whole cost, whereas for the 40% which will vest at the end of 4 years, can be written off over 4 years. So this is graded vesting also has costs which will have to be allocated in different manner for each of the tranche involved. So this is something which will have to be considered. So I am giving that how it is calculated. So using the same calculator which I presented a couple of slides before, the stock price is already a given 93.3. The exercise price is taken at 35, which is the given price at which exercise will happen. Now, expected life. Now, this is a very key and critical assumption. The expectation is, see, the minimum time for vesting is 1 year, 2 year, 3 year, and 4 year, right? So it cannot be anyway exercised before 1 year, 2 year, 3 year, or 4 years, respectively. That is a given thing. Now, having that as a given thing, what is the assumption here? The first tranche has 10 plus 1, 11 years for exercise available. However, the expected life, instead of being taken as 11 years, is being taken at 1.5 years. The reason being, in this particular case, the options were given to multiple employees, and it is already at 1/3 the price. The exercise price itself is 1/3 roughly of the current price, 93 rupees versus 35. Slightly more than 1/3, but let's say for simplicity's sake, somewhere near 1/3. Now, because of that, it is expected that people would like to encash this as soon as possible. As soon as they get the option with them, they would like to encash because it's ready money, quick money. They need not hold on for long to get growth. The growth is already there. 93 minus 35 is a growth which is already sitting for them to readily take, at least. Forget the growth it will have in the 1 year or so of vesting period. So in view of that, the assumption made was that employees are likely to exercise very quickly after the period is over. The expected volatility was taken based on whatever is the market scenario. The risk-free rates were taken for each of the tenors separately. Now you can see that the rates are differing for each of these, primarily because you need to link it to the tenor to which it applies. Dividend yield was considered at 0 because this company was not issuing dividends. So, and in general, what we find is the dividend yields are so low in the Indian companies in most cases, it has very little impact on the valuation of option generally. Again, there could be exceptions. So with that, you can see that the value of option ranges from 61.4 rupees per option to 68.38 per option for the 4th year vesting. So there are different rates which comes out, and these have to be accounted over different vesting periods. The first 61 rupees will have to be charged off in 1 year. This 63.79 can be charged off over 2 years. This 66.13 will have to be charged off over 3 years, etc. So this is the key difference which comes up. Now, why I'm specifically talking about here on the expected life, there is also a reason that if I take it as 11, then the cost can be significantly higher. Now, let's assume if I change it as 11, 12, 13, 14, and because of the longer tenor, obviously I need to change the risk-free rate also. Say, for example, it all becomes 8, right? With that, if the full life is considered, the pricing goes up from 60 odd to 80 odd, roughly about 25% higher cost. Now, understand that the ESOP costs are a debit to P&L. So a 25% higher cost debit to P&L on account of ESOP can come because of just the valuation and some assumption which is taken in that in extreme cases like this. And this is actual case of a listed company option given in the past. So, of course, slight difference in numbers could be there, but by and large. So, a 25% cost difference in what is the debit to P&L can come from this. So, the judgment which goes from the valuer and in the key things to discuss with the management are very important. Now, we need to take a fair expected life to reflect what is more appropriate in this scenario than just the last date. Now, all this time, what we were looking at was only the Black-Scholes model of valuation. So while discussing some other concepts, I've also touched upon the valuation model which can be used, which is the Black-Scholes-Merton option pricing model. By and large, most of the option valuations get done using the Black-Scholes model. However, there are situations in which the Black-Scholes model may not be appropriate to use. It may not fit the requirement, so you may not be able to use. You may have to use other models like the binomial option pricing model. There is also a third one called the Monte Carlo approach. We will discuss about that also. But binomial option pricing model is a different approach to the Black-Scholes model. And let's look at the key basics of binomial model. The binomial model is a discrete time model for asset price movements with time interval T between price movements. So it takes a movement of equal steps and it assumes a price movement. And the price movement is assumed to be only of two possible scenarios. It goes up by X, it goes down by Y. That's all. So every time it can either jump up or jump down in a particular scale on an iterative mode. So this is the assumption in binomial model. So using this, you can calculate for the future and work back. So what does it look like? The binomial model is basically like a tree structure. So you have the S, which is the stock price today. It can be SU going upward or SD going downwards. Then from SU, it can go in the next time series into SU square, which means it has gone up twice, or it goes up once and then goes down once. When it is SD, it can become again one up, one down, or both down. So like this, the tree can go on extending time series after time series. So this is the basic model for the binomial model. Now, where do we use binomial model? You use binomial model where there are options which are having complex structure. So let's suppose the stock price at the grant date was 100. The exercise price is also 100, let's say. And instead of having a simple volatility, the growth possibilities for the company is predicted as possibility 1, it can go up by 15%. Possibility 2 is a 5%. Now, here you see it's not a single volatility we are talking about. We are talking about growth possibilities which can be differing and two specific possible scenarios. Binomial really means two options of going to the next step. Then the vesting criteria is that if the market price at year end 2 exceeds 115, then options will vest. That is, it is a market price driven vesting criteria where if the share price in the market goes over 115, the options vest. Otherwise, they expire. And assume that the risk-free rate is 6% for calculation. So in a scenario like this, you cannot fit this into a Black-Scholes model. So that's where binomial model can be used to build this. So you can build the binomial tree because it's a 2-year, I have been able to build it easily here. If it was 10 years, then it will require a much more Excel building. So you have to first look at the option. So what are the options? So let's look at the binomial tree first. That is on the top here. Their starting price was 100. Now, as per our understanding, two things can happen to this 100. 100 can become 115 or 105 at the end of year one. 5% growth is one possibility, 15% growth is another possibility. Now, in year two, 115 can become again another 15% more, 132.25, or 115 can become 5% more to 120.75. The second option, if it had gone in year one, that also can go up by 15% from 105 to 120.75, or from 105 to another 5% more, 110.25. Now, as per the terms of the vesting, if it is over 115 at the end of year two, it will vest, otherwise it will lapse. So in 4 options which are coming up here, in the 4th option, it will get cancelled out. In the other 3 options, it will vest. And there will be some value to it. Now, from this, we can calculate the upstate, downstate payoff models for scenario 1, scenario 2. What will be the multiple, and what is the multiple for constant, and what is the expected result? Expected result are basically these 132.25, 120.75, 120.75, and 0. Because in the last case, we expected to lapse. And that is coming from where? These are the 4 scenarios from which it is coming. And risk-free rate is 6%. So the B multiple constant is 1.06. Now, if you solve these equations, you get these 2 computations. You get value at the end of year 1 as 115 and 11.39 at the end of year 1 for the 2 options which are there. Now you work backwards to year 0 to year 1. Year 0 to year 1, you are starting with only 2 options, 115 and 105. And this is the value it is supposed to give you, which comes from here. Mathematically, if you solve it, you get the option value at 20.52. Now, there are also some binomial calculators which are available online, but these need not fit all kinds of scenarios where binomial can be used. Binomial is basically a model where you build forward and then work backwards using the formula of payoffs. So with that, you are arriving at what is the premium which can be attached to the value at the beginning. So 20.52 is calculated using this. This also I can share an Excel sheet in due course, which can be used also. But for simplicity's sake, I have given all the computations here for the formula. So this exactly is the computation we'll have to work backwards and put for any number of years. Actually, you can do for n number of years as you may want. So binomial, by and large, is used in lesser options, a lesser number of opportunities where there are complex models which cannot be fitted into a Black-Scholes. So whatever can be fitted into a Black-Scholes, that is a more preferred model because it's simple and easy to operate. Then let's look at the Monte Carlo method, and when do we use the Monte Carlo method? Monte Carlo method of valuation is used in some unique scenarios. So let's look at the understanding of this. First of all, there are different types of options which are there. The European options are where option is computed based on exercise at maturity. Now, this is like a Black-Scholes model. In a Black-Scholes model, your assumption is that it can be exercised only on maturity, not before that. In an American model, payoff can happen anytime during maturity. So it can be an exercise period of 10 years. Now the assumption is that it can happen from any time within that. So there is a randomness which is coming in. Asian payoff is computed based on average of prices. So it is even more complex. So Asian option contracts tend to cost less and offers protection from volatility in the market. So in cases like where American or Asian is required, you may want to try and use Monte Carlo method by introducing an element of what is the exercise period at random between the period. Like for example, in the first case, going back here, in this case, instead of using 1.5 years, actually it can be anytime from after 1 year up to 11 years. So we take random numbers of between 1 to 11 at random and use that as the basis for computing the various options of what is the option value coming at different things at random, and then arrive at an average of that to determine what is a more likely method. So this is where Monte Carlo is used. Monte Carlo is basically running scenarios, multiple scenarios, and looking at the probability weighting that. That is the crux of it. So in case like American options, Monte Carlo method can be used. Or there are also other cases where there could be certain uncertainty about the future, which can be brought in by way of giving a Monte Carlo simulation, where you simulate hundreds and thousands of options, scenarios, and then take an average of those scenarios to arrive at what looks to be most logical. But as I was saying, the Monte Carlo method is the least used in ESOP valuation, especially in ESOP valuation. Binomial is used rarely in ESOP valuation. Black-Scholes is used mostly in ESOP valuation. So this is something critical we need to keep in mind. Now, with that background, as we were discussing in the Black-Scholes model, there are key areas of judgment, which is what makes or breaks the valuation. Now, what are the sources for some key inputs which we could rely on or we could look at as an option? Some of the key things I would like to touch upon. I'm talking about all the 6 factors here, but I will emphasize on some of the factors which I've also highlighted here. Underlying stock price, in the case of listed shares, simple market quotes can be there. In case of unlisted shares, it has to be based on a valuation of the shares as on the date of the grant. For each grant, it has to be done theoretically. The strike price is the price at which the option is exercisable as per the contract or scheme. So there again, there is not much of a work which is involved in determining that. Time to expiry of option, it has to be generally based on the scheme or contract. However, we saw cases where the time frame is given to be significantly large but likely to be done much earlier. You need to consider what are the likely opportunities of having something else happening. So accordingly, you need to factor that. For example, if I am giving a share which is currently trading at 93 rupees at an exercise price of 35, and I am giving a 10-year exercise period, would people actually wait for 10 years or would they exercise much earlier? Because it is significantly in the money already. So these are things which we need to consider there in the expiry of option. Volatility is a key area which requires further attention. Specifically, we will discuss about this in the ensuing slides. But let's round up the other items. Risk-free rate, you can get market data on GSEC yields. Then from that, you can take based on the tenor which is close to the exercise period and vesting period together. That is the total time period. And then you can use the appropriate rates from that. Mostly that should be fine. Dividend yield can be based on historic trends or an estimate for the future based on the dividend payout ratios, etc., which can be the basis for determining a dividend yield. But like I said, in many of the Indian scripts, generally dividend yield has very limited impact or implication, because Indian market is not tuned to working on dividend as a driver for value. Now let's look at the most important thing, volatility. How do we estimate volatility is the key thing which we can look at here. Mostly other parameters are easily available in ESOP valuation as compared to volatility. There are broadly two approaches that can be taken to determine volatility. One, it can be estimated from historical data. Now, how can it be done from historical data? Assuming your company itself is listed, you can do an analysis of past 5 years or substantial period analysis to identify and compute the volatility your script has had in the market. A. B. If your script is not listed, then you can look at comparable companies which are listed in the market, take those companies, calculate their volatility, and use that average or median, etc., as a measure of what would be the applicable volatility for your script. So these are two sub-methods under the method of estimating from historical data. The second way of looking at it is possible only if there are highly traded options in the market for your scripts or similar scripts. Then you can calculate the implied volatility from the options which are being traded in the market. So this is the second approach which can be taken. By and large, the second approach would apply only where you have options also being traded for that script in the Indian market, which is limited in terms of the number of companies for which such data is available today. So by and large, we again come back to relying on historical data of your own company if you are listed, or comparable listed companies. How the volatility can be computed also? It is basically taking the variance and arriving at from that. What does this volatility really mean is what is important for us to understand. So let's understand it from a very simplistic manner. What does this volatility mean? Now, let's suppose if today's price is 77, what you would like to know is what would be the price tomorrow. That is the next trading date. It will go up, it will go down. What will happen to it? So annual standard deviation, let's say, is 5.81%. Now, if you take that as the basis, daily deviation is about 0.3%. So the likely price range tomorrow, based on these data, would be on a normal distribution pattern. It will be within 1 sigma, that is 77.23 and 76.77. That is 77 becomes into 0.3, right? That is 1 sigma above or 1 sigma below, with a probability of 68.27. Now, if you want a probability of 99%, it will be somewhere between 77.70 and 76.30 next day. This is the normal distribution theory which is being applied in here. This exactly is what this sigma denotes, the volatility denotes. So over a period, it computes like this. What is the likely scenario of the prices, the movement in prices? And that's how volatility helps in computing the option pricing. Of course, we all know about the normal distribution, so I'll skip this part. Till now, we were talking about the valuation, and we were also talking about the key ingredients which are going into determining the valuation, where you can look for that information from, etc. Now let's look at how do you account it in the normal course, and what are the accounting implications which needs to be understood and considered. So, as I was mentioning, there are two types of entities in India, entities which are following Ind AS, entities which are following AS. Now, the IGAP permits two methods of accounting, the intrinsic value method or the fair value method. Though the latest guidance note actually recommends the fair value method, it permits the intrinsic value method in the case of companies following AS. Under companies which are following Ind AS, only fair value method is permitted. Intrinsic value method is not permitted for companies which are following Ind AS. So Ind AS 1 or 2 prescribes only one method. Now, what is the difference between the intrinsic value method and the fair value method? Now, here, what we need to understand is, here when we are talking about value, we are talking about the value of the option and not value of the share. What is the value of the option? If you are permitted to buy Hindustan Lever at 1,000 rupees for the next 6 months, when today's price is 1,000 rupees for the share. Now, this option which you have to buy it at 1,000 rupees for the next 6 months has a value to it. That is the value of the option. That value might be 5 rupees, 10 rupees, 100 rupees, something. It is not 1,000 rupees. 1,000 rupees is the value of the share, whereas the value of the option is what is the value you perceive or you will place for the option you are being given to buy at the same price for, let's say, 6 months. Now, in the case of intrinsic value method, the option value is determined in a simplistic manner. So my exercise price is 1,000, my today's market price is 1,000. So the option value is 0. So the intrinsic value in the given example now we were talking about, where let's say Hindustan Lever is trading at 1,000 rupees today, and you have an option to buy that at 1,000 rupees within 6 months, both being 1,000, that is the exercise price and the stock price being 1,000, the value placed on the option is taken as 0. So the debit to P&L is 0. Now this is the intrinsic value method. But we all know that the time value of being given this opportunity has a value to it. So how do you compute that value? If you place a value to it on a fair valuation model, then that is the fair value of the option. Now that fair value of the option is what you compute using Black-Scholes model or binomial model or the Monte Carlo approach. So you're not valuing the share using Black-Scholes or binomial or the Monte Carlo option. Here you are valuing the option which is on top of the share. That is what you are valuing using one of these models. Now the accounting requirement, like I said, in the intrinsic value method, it's simple. Whatever is the fair value today, that is the share price and the exercise price, the difference is taken as debit to P&L. In the fair value of option model, the fair value of share is determined. The option value is identified using one of the models, and that is taken as the cost, which is debited to P&L over the period. So this is the key difference which needs to be borne in mind. And the recommended method under AS and the only prescribed method under Ind AS is the fair value of options method. Though for companies following AS, intrinsic value method is permitted today. So with that background, let's take an example of, say, 1,000 employees, each employee being given 200 grants. Vesting period is 3 years. Then thereafter, exercise period is 3 years. Expected life in years, assuming there is going to be some early exercise, it's 5 years. So instead of 6 years, in 5 years, you are expecting that most of it will be exercised. Exercise price is 25 rupees. On the grant date, the share price was also 25 rupees. Expected forfeitures per year is 2%. That is, every year you expect people to have some lapses happening because they left the job or because they did not meet some criteria, about 2%. Then, on this basis, let's say you calculate using Black-Scholes model and assume you have arrived at the fair value of option at 10 rupees using Black-Scholes model. Assume you have arrived at 10 rupees. Now, the forfeiture, which was estimated originally at 2%, the actual were as under end of 1 year, 2%, actual lapses were 3%, end of 4 year, it should have been 4%, which was also like that. End of year 3, it doesn't apply because there were actually 840 employees completed 3 years, 160 did not, right? 1,000 employees made. 160 did not complete 3 years. So this is the given facts of this thing. With that, let's see how the accounting has to be done. Now, the options granted were 200 into 1,000, which is 2 lakhs, which is what is shown here, 2 lakh shares. Out of the options which 2 lakhs which were granted, it is expected that only 188, 238 will mature because every year we are expecting 2% to have forfeitures happening. So it is 2 lakhs into 1 minus 2% for year 1 into 1 minus 2% for year 2 into 1 minus 2% for year 3. So at the end of 3 years, we expect only 1,88,000 shares to mature. So 1,88,000 shares into 10 rupees option value per share is 18,82,000 is the total cost of the options granted. Now this total cost of options granted, 18,82,380, what you will do at the end of year 1, you will take that 1/3 of that to debit to P&L because it is over 3 years, right? It's over 3 years. So you take 1/3 of that to P&L, 627,460. Now we come to the end of second year. At the end of second year, what has happened? You know that there has been an actual rate which has been different. So now you expect that only the actual forfeiture has been different. It has been 4% instead of 2%, etc. So now, based on your revised estimate, you expect that the 200,000 you started with will only end up with 176,947. 176,947 as the actual number at the end of 3 years, right? So that is the current outlook. So at 176,947, you will have to write it off over 3 years. So in 2 years, you should have written off 17,69,000 divided by 3 into 2, 11,79,000, of which you have already accounted 6,27,000 in the previous year. So balance 5,52,000 you will debit to current year P&L. By the end of third year, you know only 860 people have actually got the vesting criteria met. 160 people have failed. So the 840 people who cross the criteria will only get the 200 shares. So 1,68,000 will be the revised number at that time. So see here, every time we are only revising the number of options and not the rate, right? The rate has remained the same. The valuation of the option done on the grant date is not being changed. It is only the number of options which are estimated is being revised year after year. And whatever is the differential is getting booked to P&L. Right? So taking it forward, okay, so 16,80,000 got accounted, fine. Now 60,80,000 getting accounted. Let's assume what happens after that date. The employees we were exercising at the end of 5th year, let's say 200 employees exercised, and that 200 employees means 200 into 200, 40,000 options got exercised. So when 40,000 options get exercised, 4 lakhs will go as capital, which is the 10 rupees which has come in, right? 4 lakhs will go as exercised. Then the balance amount relating to that will go into premium. 10 lakhs will go into premium. Why would it happen like that? Because they are going to pay 25 rupees per share. And you have estimated 10 rupees as the option value. So they are going to pay 35 rupees per share, right? Or rather, there is going to be a 35 rupees per share, which is available, 25 by way of cash collected, 10 by way of what you have accounted as grant cost here, 16,80,000. So for 40,000 shares at 35 rupees, it is 14 lakhs. 4 lakhs only will go into capital. The balance 10 lakhs will go into premium. This is what will be the accounting. And that 10 lakhs, how will it get accounted? 4 lakhs will get accounted to stock option. 10 lakhs will be by way of cash received at 25 rupees per share on exercise. That's how it gets accounted. Then let's assume another 600 people exercise in the next year. For that 600, similarly, 120,000 options will be there. 12 lakhs will get accounted as capital. 30 lakhs will be accounted as premium. 30 lakhs will be received as cash at 25 rupees on exercise. And 12 lakhs will get adjusted to options. Now 16 lakhs have got adjusted to the option account. There is a 80,000 balance lying there. Now, what happens if nobody exercises by the end of the 6th year? Let's say the period is over. Then the balance expire. So 40 people's balance expire. And that 80,000, which is relating to that, which was originally debited to P&L and credited to stock option reserve, that 80,000 will get directly moved from stock option reserve to general reserve. So when you debit cost during the vesting period, the debit goes to P&L and credit goes to stock option. Any change in number of options because of pre-vesting lapses, that is before the vesting, any lapses happens, it gets adjusted here in the grant cost. The debit to P&L is on a incremental basis. So it gets adjusted to the grant cost and debit to P&L. But any expiry post-vesting will not impact the P&L, but will get directly moved from the reserve created, stock option reserve created, to the general reserve. Right? I hope this is clear. So we move forward with that. So then you can look at various options like, if there is a change in the performance criteria. So vesting period changes. So initially it was considered that 2 years will be the vesting period. Then because of the performance criteria, the vesting period becomes, instead of 2, now it becomes 3. So the vesting period at the end of 1 year was considered as 2. At the end of the second year, it was considered as 3. So you will find the same calculations are there. Only thing is, originally we would have taken 1/2, 9.41 lakhs, 1/2 of the total cost into the debit of P&L. But by the time we come to the second year, when vesting period has been increased to 3, we would have taken only 2/3 of 17.69 lakhs as the cumulative cost, and out of which 9.5 is already accounted, only 2.38 lakhs gets accounted in the current year. Similarly, when number of options vary based on performance criteria, so instead of 200 as a standard options being given, let's suppose the number of options were varying based on performance criteria, and let's say at the end of year 1, we estimated only 150 options. At the year end of 2, we estimated it to be 225, and year end 3, it became 200. Then again, if you see the calculation, at 150, the total options would have been only 141, 179, and 1/3 would have got accounted there. Second year, when we increase the options to 25, the incremental debit will automatically go into P&L in that year. So any incremental adjustments or decremental adjustments to options based on lapsing or performance criteria generally goes to P&L in the year of change. This is the accounting principle. Very simply put. Right? Now, this is with regard to accounting for options. Let's also look at how it is different in the case of shares and SARs, SAR and phantom stocks, or both are by and large similar. So let's look at the SAR example using the same kind of ESOP example. So instead of an ESOP, they are going to get the share appreciation rights. That's it. So in the SAR, what happens is, till you come to the vesting is completed, you are going to recompute the fair value of option every year. Now, this is the key difference. In ESOP, generally, you don't recompute after the grant date. But in the case of SAR, because it is to be cash settled and money is to be paid out, right? It is on the appreciation rights, even if the appreciation value is to be paid by way of equity at a later date. But because it is the appreciation which is going to go to somebody and not the stock per se, the fair value will have to be recomputed every year. That is the key difference in this. And after the exercise period is over, when it goes into the, after the vesting period is over and when it goes into the exercise period, the intrinsic value of the share is what would be determined periodically to recompute the balance cost which has to be accounted. So this is the key difference which will come. So in this, you will find that every year we will be recomputing based on the revised fair value, and on that basis, the debit to P&L will be computed. Before we go to the question answer session, I would like to touch upon one more thing. See, ESOPs can be valuation of ESOPs we saw for the purpose of ESOP, either at the time of grant and as we discussed, it is also required to be valued by merchant bankers at the time of exercise for the purpose of determining perquisite value. We can also touch upon how we should deal with ESOPs when we are doing other valuations. Let's suppose we are doing a valuation of the equity of a company and the company has an ESOP pool. Now, how do we deal with this ESOP pool when we do the valuation of the company and valuation of equity share of the company? So let's look at a simple example. As on 31st December 2020, company has 1 lakh equity shares issued to its 2 promoters. So 50,000 each, 2 promoters hold, nothing else. Then the company has also implemented a ESOP scheme where under 10,000 equity shares are earmarked for the scheme. The exercise price is 50 per share. Discount rate considered is 15, for example, let's say. Of these, 4,500 shares have been granted. 5,500 shares are yet to be granted. And out of the 4,500 shares which have been granted, 2,000 are vested, 1,000 are expired, 1,500 are yet to be vested. So there are shares lying in different criteria. Let's say the company has no debt or other instruments. So simply put, this is the only equity and which is there. The enterprise value, let's say, was determined for the company at 2.5 crores. So basically, this 2.5 crores is the value of the equity shares and ESOP pool, right? This is what it is. Background. In such a scenario, how do you do the valuation? Now, let's look at 4 possible scenarios. Only issued shares are considered. So, how many shares are issued? 1 lakh shares are issued. What is the enterprise value? 2 crore 50. So, what is the adjusted equity value? 2 crore 50. Per share value is 250 rupees. Now, this is a simplistic model. ESOP is completely ignored. Now, let's look at the second possibility. Vested and to be vested is also considered. That is, what is lapsed is not considered, and what is yet to be granted is also not considered. So only 2,000 which is vested and 1,500 which is still live to be vested. So you have already granted options to employees. So you have promised somebody, right? You have promised somebody and they have the option still to take those shares. So you consider those shares alone. So 3,500 shares you are considering, right? So 3,500 shares you are considering in addition. And for the 3,500 shares, you will get some money. How much money you will get? You will get 50 rupees per share. Now that 50 rupees, you have to adjust for time value. So adjusting for time value on an assumption, on a discounted for time value basis, let's say comes to 13 lakhs. Or sorry, 1.3 lakhs. Now my value of adjusted equity is 2 crore 51 lakhs because this money will also come. But my denominator will be 103,500. So my average cost is 242.82. Now the third possible way of looking at it is I take those vested, to be vested, and to be granted. That is, I only ignore that which is expired. So in the previous sheet, we saw that 1,000 have expired, 3,500 are in the vesting, 5,500 is yet to be granted. So which can be, the board has the powers to give 5,500 more. So I take that 5,500 also, I arrive at 9,000 shares, right? So for 9,000 shares, if I will get 50 rupees at the discounted value for discounted for the time, I get 3,40,000. So at this option, my average share price comes to 232.48. Now, the fourth possibility, I consider all the ESOP, full 10,000 ESOP. In that option, I get 230.7. Now, there are 4 ways of dealing with it. What is right and what is the method to adopt? So that is where I have given some indication where you can consider these, etc. And what is probably, this is generic. There could be more specific input which needs to be taken on a case-to-case basis, but this is more like an eye-opener for people to apply their mind as to what to look for. Now, the first case is completely not appropriate. That is, to completely ignore the ESOP which is there is not appropriate. So that has to be not the method used at all. Now, the second option where you are taking vested and to be vested alone is probably where transaction provides for accelerated vesting and cancellation of the scheme. So in such cases, what you can say is that, okay, 2,000 is already vested. Another 1,500 is to be vested, but as per the scheme, the whatever is to be vested will get vested and the scheme will get cancelled. The moment the scheme gets cancelled, the 5,500 which is not yet granted cannot be granted under the scheme. So in such scenarios, so in shareholders agreement, generally these kind of terms will be there. You will have to look at the structures to see how it is being done. So in a transaction which provides for accelerated vesting and cancellation of the scheme, this may be more appropriate. Then the third is more appropriate where the transaction provides for continuation of the scheme, but the scheme does not have reissue feature. So this 1,000 which has expired, there is no reissue feature, then the third may be appropriate. The fourth may be appropriate where the transaction provides for continuation of the scheme and the scheme also envisages that any lapsed quantity can be reissued by the authorities, whoever is empowered under the ESOP scheme to newer employees or other employees. So in such cases, the fourth may be more appropriate. Now, these are critical to consider, especially where values involved and volumes involved could be significant. With this, I would like to take a break and look at the questions so that we can discuss on the questions and answers. So we will have some time, 20 minutes or so, to look at question answers. I would be happy to take it. And anything else also, my mail ID is always available in my presentation and everywhere. Anytime on any valuation query, I would be very happy to reply. And generally, I try to reply within 24 hours. Thank you. I will stop here and look forward to the questions so we can take it forward. Thank you.
Thank you, Balasubramaniam sir. In fact, members have dropped in many questions. So straight away, I'll come to those questions.
Sure.
The first one is generic. It says how the ESOP valuation is different in case of private limited companies. So that's the query.
See, like I was telling you, ESOP valuation has two components to it. The first component is the valuation of shares, especially in a private company where it won't be listed. So the share has to be valued because that is the underlying based on which you can do the whole computation. So the share valuation itself will be driven by intrinsic methods. You don't have a market value to just take and plug there. So that is important. And generally, when you are doing valuation for ESOP, you will do based on intrinsic value of the entity's business rather than by on any other basis, which could be driven by current sentiments, etc. The second component is valuing the options per se. When you are valuing the options, there are 2-3 factors which needs to be considered. The first factor is the critical factors, I would say. First factor is the time period which you are going to take. Now, the time period has to be considered in an appropriate manner, especially in a private company, because at the time of exercise, the employee has to pay money to acquire the shares. The exercise price has to be paid. And if the exercise price is significant, the employee will not have the cash flow to do it. He would rather do it alongside a transaction which is going to happen, or when he can immediately sell, or after the company goes in for IPO, etc. Now, this is a factor which needs to be considered. How exactly is that going to happen, or when it is likely to happen in a given scenario? So these are areas where there can be differences coming. The second thing which can impact on the timeline is the other way around I was explaining, where it's already significantly in the money. then you may think that this people will not hold it on for so long. They would actually exercise it much earlier so that they can encash it and go. Third is companies which have higher attrition rates, etc. Again, there is a likelihood that employees would exercise it early, especially if there is a mechanism provided for exit for employees who hold shares and who are leaving the company. So this is one. So time to expiry is one area where there could be a significant difference which can come, especially in a private company, which we need to look at. The second is the volatility. How to determine the volatility? Like we discussed, you have to look at comparable companies. Sometimes comparable companies itself may not be available, which are listed. Then you may want to work with the industry average or the index average, sorry, not industry average, index average, which you can use. But by using those, you can use some index which is more closer to the company's industry, etc. But by using those, you are actually making deviation from what is most appropriate for the company, obviously. So it is amongst the data available, which is the closest you are taking. So you may want to make some suitable adjustments at times. I would generally suggest that you run a sensitivity test on the volatility to see how much volatility is having an impact on the valuation. So depending on that, you can deepen your research if required in private companies. These are two critical areas, I would say, on the option valuation side in private companies.
Well, the second question relates to whether only the registered valuers can carry out the ESOP valuation or others are also permitted.
See, there are two schools of thought. One is people have taken a view that a valuation under the standards is a valuation required under the Companies Act because the standards are notified under the Companies Act. And because it is required under the Companies Act, it can be done only by a registered valuer. There are also people who have taken a contrary view saying that this is valuation required for accounting and not for the purpose of Companies Act per se. So this can be done by a person who's not necessarily a registered valuer. Being a registered valuer, my personal vote is for that it is covered. Even otherwise, technically, my view is that because the standards are today notified under the Companies Act 2013, it is a valuation under Companies Act and should be done by a registered valuer.
Well, coming to the next question, it says that when is that the RV report is going to be required, and how is it different from the requirement from the merchant bank report? And then he clarifies that the valuer report is required only at the year end for accounting purposes, but on what basis can a company frame the ESOP policy and who can value the company for this purpose?
Okay, so let me go through the life cycle here very quickly. ESOP policy framing is more a commercial decision. There is no valuation involved. I can decide to give the share at 1 rupee. I can decide to give the share at the market value of the share. I can decide to give it at 50% of the market value of the share. It's purely a commercial decision. Now, ESOP valuation is required for accounting of the cost of ESOP because there is a scheme being given and it is presumed there is a benefit being given to the employee in the process of ESOP. There is a cost which needs to be determined, estimated. So it is like the actual valuation. It is a valuation done for a specific purpose of accounting. Now, this is to be done not at the year end. Generally, this is to be done as of the grant date. So the ESOP cost calculation is done as of the grant date. Only in the case of SAR, there is an annual valuation which is done. and in some other exceptional cases where the number of this thing itself will change based on performance criteria. So there are very, very limited cases where annual revaluation will be required. Otherwise, each ESOP grant is valued only once at the time of grant for accounting purposes. Now, in accounting, what are you calculating? You are calculating the cost of the option, or the value of the option, which will be debited to P&L. This is what is done by the RV. Now, coming to what the merchant bankers do, they do at the time of exercise, they are determining what should be the perquisite value in the hands of the employee. The employee is paying an exercise price and getting a share. On that day, he's actually getting a share, right? So when he gets a share and he's paying X amount for it, if the value of the share and not the option, because option is gone by then, the value of the share is more than X, that minus X is payable as perquisite. I mean, it's taxable as perquisite. So to compute that, the valuation has to be done of the share. And the share valuation is required to be done by a merchant banker under the Income Tax Act. Currently, this is how it stands. I think that clarifies that.
Thank you. In fact, there is a specific question now from one of the members. He says that if company is issuing ESOP for parent foreign entity, how does accounting changes in such scenario, and company has to reimburse such cost to parent entity? What will be the accounting of such reimbursement and related valuation as per accounting standard?
Okay, so basically when a parent company, see, I'm not going into the FEMA aspects right now, right? Let's leave that out. Let's look at it from an accounting and valuation perspective. When a parent entity issues options, the valuation is of the parent entity's equity, which is being given. So all the valuations which have to be done should be done for the parent entity's equity valuation. Now, depending on, and my view is that the debit to that cost should be taken by the subsidiary, which is actually getting the benefit of the employees. What is happening in substance is the employee is serving the subsidiary is getting the benefit of the employee, for which the employee is getting compensation by the parent. So obviously the cost belongs to the subsidiary, should be debited to the P&L of the subsidiary. Now there are two possible scenarios in that. There are cases where the cost is to be reimbursed to the parent, in which case they normally compute the costs and debit it to the subsidiary and collect the money. Again, I'm not going into the FEMA aspect, how this works. That's a separate subject by itself. We'll not get into it. Second, if the parent is not debiting this, it is giving it free, basically, right? Then at the subsidiary level, actually the cost will have to be taken to the P&L and the credit has to be taken to equity, because as an equity contribution by the company, parent. So technically, this is how it should be accounted. But pragmatically, if the values are not significantly large, in the second case where there are no debits coming, they give a note and they don't debit or credit anything pragmatically. On materiality, basically on materiality. If it is material, my view is it has to be debited to the P&L and the credit has to be either to the parent or to equity if the parent is not going to charge for it.
Now, next question is what will be the accounting if the shares are allotted after vesting at zero value to the employees? That is, the exercise price is zero value.
If the exercise price is zero also, the value of the option which is calculated will be significantly higher. See, if you put zero in Black-Scholes model, it will give you an error. So you put 0.00001 and calculate, it will give you an option value which will be significantly higher than it would have been otherwise. And the accounting will still go on the same basis that on the date of exercise when the shares are allotted, the amount which is lying in stock option reserve The stock option reserve would have been created by debit to P&L every year of the ESOP cost during the vesting period. That stock option reserve will get allocated to capital and balance to premium. So the accounting will follow exactly the same whether the money is collected as at 10 rupees, 25 rupees, or zero.
Thank you. In fact, let me make a general statement that there are a couple of queries from the members whether the presentation would be available and the session is going to be hosted. Yes, the session would be hosted on the ICI RVO Knowledge Portal. So we'll share you the details when it is hosted. And as regards other specific questions, in fact, in the interest of time and since the speaker has spoken so long for about 2 hours, what we will do is because some of the questions are very specific, making reference to specific slides. So if Balu sir agrees, then maybe we send you those questions and in a reasonable time, say in next 15-20 days time, we'll be coming out with a booklet on the proceedings of this particular webinar, wherein the reply to these questions would also be covered. So I think that answers the general queries of the members who have joined us. And let me come to the end of this session. Thank you, Mr. Balasubramanian, sir, for taking this session in most pragmatic and the kind of examples and the way you explained the entire mechanism. It was simply brilliant, and thank you so much for the hard work put in. And I think it should have clarified and added value to the understanding of the members and all others who have joined. So, with this, we come to the close of this session. And thank you once again to all those who have joined, and especially to our speaker for the day today, Mr. TV Balasubramanian, sir. Thank you
Thank
so
you.
much.
Thank you.